Let's get straight over to Rick Santelli. He's standing by at the CME in Chicago. And Rick, take it away.
Absolutely. We'll start out with the data I see first. November read on housing starts, 1.547 million seasonally adjusted annualized units. This just blows away all expectations. Huge number. And if we look at the permits, 1.639 million seasonally adjusted annualized units. Oh, my goodness. That's up over 6% from the last look. These are just unbelievably strong data points for housing. It's unreal. Okay, December read now on Philly Fed, expecting 20. This one's a miss, almost a half a miss. 11.1, that's the lowest read since it was negative in May at minus 43.1 because, of course, it's been moving into positive territory. Now the money ball, initial jobless claims up. It's 885,000. 885,000. That's up, what, 32,000 from 853,000, but that may get revised. This is not good. Remember, 711,000 was the low since coronavirus hit. That was the week of November 6th. We're really starting to outdistance to the wrong direction. And on continuing claims, this one's pretty good. As a matter of fact, this one is so good that it is now the lowest continuing claims number at 5,508,000. 5,508,000. This eclipses 5.52 million. That was a November read. So this is the lowest read since COVID hit, and it is progress. Of course, we're all going to say in unison, we need these numbers to go down faster. Every one of these numbers represents somebody that needs some help with regard to either trying to get some work because theirs has been closed or the businesses they work for no longer exist. The revisions are starting to come in. I thought they would. The 853 on initial last time turns into 862, which now stands at 885. And on continuing claims, the revision was to the upside, not a lot, from 5.75 to 5.78. But as I said, 5.508, that's a new low water mark. These are good numbers, at least based on expectations. So really, initial claims in Philly go the wrong direction. Interest rates, they haven't really ticked up much. I think the bigger story for long-dated treasuries is what happened yesterday. Very dovish Jay Powell, but a very bullish underpinning to some of the data points and thoughts as to where the economy may be in the second quarter of next year and beyond based on other Fed personnel. Becky, back to you.
Rick, stay right there. Let's bring in Diana Olick. She's here to dig into the housing numbers that we just heard. Also, Steve Leisman on jobless claims. And Steve, let's start with those jobless claims because that is the bigger number and one that's a little concerning.
Yeah, you know, Becky, we can't say we didn't tell you this was going to happen. Look, you have the surging virus out there. You have the waning stimulus that's out there. And the expectation was that you were going to have this increase in joblessness. The market has decided that this does not matter a whole lot because I think of A, the idea that stimulus is coming, and B, as we heard yesterday from Powell, the Fed is going to remain wide open. Whether or not that actually offsets the economic impact of the rise in jobless claims, and the idea that Powell told us yesterday, this is going to be 4 or 5 months of pretty lousy data. And I'll stop there because there is one bright spot that Powell mentioned yesterday, and that's the interest rate sensitive sectors. And, housing is almost certainly one of them, Becky.
Shepard Smith here. Thanks for watching CNBC on YouTube.